Is that sort of astonishing? It's supposed to be astonishing. It was astonishing to me, when I started teaching money in banking, to appreciate there's this enormous thing going on there, and most money and banking textbooks don't mention repo. They don't mention it really at all. They're focused on the retail money market. They're focused on household making deposits or something like that. They're focused on what banks do. And because this is a security dealer, you say, well, that's not part of our subject. Okay? This is where modern finance has just changed the world. Okay? The fact that it's not called a bank doesn't mean that it's not operating like a bank. If it is producing liquid liabilities, this is money supply for somebody in the economy. By the way, this is not necessarily a pension fund here. This could be a money market mutual fund, a money market mutual fund that holds repo as its assets and issues deposits to foreign central banks or something like that. So yes, this stuff is money. If not directly from a sophisticated corporation, then indirectly by passing it through a money market mutual fund first. I said last time that in your intermediate macro textbook, okay, it spoke of open market operations as being the Fed going and buying Treasury securities or selling Treasury securities in order to change the money supply. Okay. What really is going on here, okay, is the Fed is buying and selling to the dealers. It's the dealers who make these markets in securities. Okay, so it's not like going to some business or some household or some pension fund and buying a treasury bill. Maybe eventually it comes from there, but the immediate thing that happens is that the Fed asks these dealers, these primary dealers, to bid. It says bid for this stuff that I want to sell you. Okay, and I want to show you this. So here, for example, are the temporary open market operations. Here are the last 25 interventions in the market that the Fed did. This is on the balance sheet of the, this is on the web page of the New York Fed. In normal times, before the crisis, the Fed is trading in the repo market every day, pretty much, okay? Not anymore, because there's all these excess funds out there. Okay, but it is still occasionally trading, and you can see, and that's what I'm going to trying to show you here, what those trades look like. Here's my laser pointer. So here is the most recent one. Okay, this is actually a reverse repo. Here, you can see there. This is the Fed going and saying to the dealers, I would like to borrow money from you. I would like to offer security to you. I would like to offer you treasuries, agencies, mortgage-backs, okay? And I would like you to lend me money, okay? And you tell me what price you're going to give me. You tell me what you're offering, and I will tell you who I want to do business with and how much, okay? That's what these things are. So these are the bids that are submitted by the dealers, and you can see the amount of them, 4.3 billion. This is the amount of business that the Fed actually did, 2.25 billion there. The stop out, this is the minimum yield that they accepted. There's an average of the different bids, high and the low of the bids there. So they're doing business with the dealers, and you can see this quite literally. They're reporting this on the balance sheet here. That's a reverse. So when this all, you see what it says there. It says. It's a reverse. There it is. The deal date is this. Delivery date is Thursday the 13th. The maturity date is Monday the 17th. So this is several day reverse repo. And they have a little footnote there. It's part of an operational readiness program. Okay, so they're practicing. That's what they're doing here. They're hoping that maybe they're going to be able to use this mechanism to shrink their balance sheet or to get rid of all of these excess reserves, because that's what this does. You say to the dealers, I want you to lend me money. Okay, what that winds up doing is substituting on the Fed's balance sheet, is shrinking the Fed's balance sheet well, I'll show you that when we get to the other side. So this is weird that the Fed is doing these reverse repos now. well, I haven't written reverse repos there, but because for a long time, and you'll see this in Stigum, the Fed refused to do this, or when it did reverse repos, it wouldn't call them that, because it would call them matched sale purchases, MSPs, and it's because it didn't want to be seen as somebody who needed to provide collateral in order to borrow in the money market. It's like, I'm the Fed. I print this stuff. Why do I need to provide collateral? I'm not going to be treating myself as if I were some security dealer. Now they're calling them reverses, and they seem to be willing to do them. And so the Fed is just acting like a bank, you know, doing reverses here. What we saw there, we were looking at the prices they were charging. You have to go back to August to get an actual repo that they've done, because repos add reserves to the system. Okay, reverses pull reserves out, and they haven't needed to add because there's $1 trillion worth of excess reserves here. And so you can see it's the same situation here. There's the deal date. This is when the delivery date is 7. And again, they're going from Tuesday to a Friday during a week there. So it's 3 days. And again, there's different collateral. These are the bids. And they seem to have accepted all of them. And these are the stop out rates. So it's the same, but they're on the opposite side of the transaction. When the Fed is doing repo, okay, what it does is make a repo loan here, okay, and it increases reserves here. So that's an expansion of the Fed's balance sheet in this way. I showed you this last time. Now I'm going to expand on it a bit more. Okay. The Fed is immediately doing business with a dealer and that's all I showed you last time. Now I'm going to show you one more level, okay, which is the dealer has a bank. Okay. What happens here is that the dealer is borrowing money. The dealer doesn't have an account at the Fed, so the dealer can't hold reserves directly. What the dealer does when he is paid is to increase his deposit account at the bank. Okay, so now you see how that all adds up. Okay, these reserves here in the banking system come from the Fed doing repo with the dealer. The Fed is doing repo with the dealer, lending the dealer money, and the dealer is providing security, a treasury bill or one of these other things. Okay, and those reserves wind up in the bank because the dealer deposits them. Now, it may be that the dealer is borrowing from the bank and just repays some of that loan. That also could work to increase the reserves. Either way, the reserves wind up on the balance sheet of the bank. And if those are excess reserves, maybe the bank takes those to the Fed funds market and lends them or something. So this is the notion of influencing the Fed funds rate by these open market operations here.